the trade tensions and the VIX spike is the reason investors are a little cautious. But I don't think that's going to change that markets still have a lot of tailwinds into year end. And part of it is AI is like, I think demand is accelerating there. And we know that investors are sitting on a lot of cash, and institutional investors are really having a terrible year. Only 22% are beating the benchmark. So I think there's a bit of a chase. And then sentiment has flipped negative, which is always a contrarian buy signal. So, I think despite this mounting wall of worries, including the shutdown, I think it sets us up for a pretty good rally into the end of the year.
This is an incisive breakdown of Tom Lee's latest market prognostications, offering a granular perspective on the forces shaping our financial landscape. Lee, echoing sentiments from figures like Jamie Dimon, acutely identifies the opacity within private credit as a burgeoning concern, a problem he believes investors will contend with for the foreseeable future. This lack of transparency, coupled with persistent trade tensions and the recent VIX spike, has undoubtedly injected a degree of caution into market participants. However, Lee maintains a resolutely bullish outlook for year-end, positing that significant tailwinds remain. He points to the accelerating demand within the AI sector, the substantial cash reserves held by investors, and the widespread underperformance of institutional funds, creating a chase dynamic. Crucially, a flip to negative sentiment, historically a potent contrarian buy signal, further underpins his conviction for a robust Q4 rally, even amidst a mounting wall of worries, including potential government shutdowns.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
Hey, so what's your take on everything that we are talking about now daily?
Well, I heard the earlier segment, Scott, and I do think I'm kind of more in the Jamie Dimon camp, that and Steve Leisman's point that there's opacity in private credit, and that's the problem that investors are going to grapple with for some time. And I think that, along with the trade tensions and the VIX spike, is the reason investors are a little cautious. But I don't think that's going to change that markets still have a lot of tailwinds into year end. And part of it is AI is like, I think demand is accelerating there. And we know that investors are sitting on a lot of cash, and institutional investors are really having a terrible year. Only 22% are beating the benchmark. So I think there's a bit of a chase. And then sentiment has flipped negative, which is always a contrarian buy signal. So, I think despite this mounting wall of worries, including the shutdown, I think it sets us up for a pretty good rally into the end of the year.
It sounds, though, like this is enough on your radar that do you think it's at least changed the game in the near term for the market?
On the private credit?
Just overall, I mean, if there are continued issues in private credit and the leveraged loan market, then the stock market's not going to take that well. I mean, you wouldn't think.
Yeah, I mean, Scott, the only thing that I don't know is how many chapters it's going to take to play out, because there's opacity, which is what is scaring people, but then there's real credit deterioration, which I don't think that's what's happening, and I think that's why Adam and all those had called it idiosyncratic. I'm kind of in that camp because high yield spreads have behaved. So I think it's more of is the flow of capital, because I think one of the biggest sort of allocations for alternatives has been private credit. It's going to make investors pause that, maybe this market it's not as easy a return as it looks.
You told me, I think, a couple of weeks ago that 7,000 on the S&P by the end of the year was realistic. You still think that we could get another 5%? That's what it looks like. It's 5% between now and then. Do we have that in us?
Scott, I mean, 5% is just an average fourth quarter from 1950 to 2024. But we have the Fed easing after an extended pause. So that's 1998 and 2024. So I think that 5% might be the base case. I bet you it's going to end up being more like 7 or 8% or even possibly 10%. So I think 7,000 is the low end of what we can end the year at.
Wow. And how much do earnings have to do with that?
I mean, earnings are going to matter, but it's been a good start. I mean, we're barely into earnings season. The banks have been good. 82% of companies are beating. There's a lot more visibility of demand and then less concerns about tariffs because we're kind of working our way through it. So companies have a better sort of visibility over the next 12 months, I think the outlooks are going to be good, and I think that's going to help stocks. And, I think there's a lot of room for multiples to still expand. So I don't think this market's that demanding.
I think it's interesting that you suggest that you'd be a buyer of regional banks and small caps. Why
Yes.
are you willing to do that? That's not putting your toe in the water. That's like putting the bathing suit on and jumping in. Why?
Well, I mean, Scott, I know there's a lot of muscle memory for people from 2023, and that was because of a big change in rates that really caught a lot of banks offside just in their business model. But that doesn't mean that this crisis, which is underwriting being done properly, should have the same issue. So I think that there has been a throw the baby with the bathwater out on the regional banks and the small caps. So yes, I think despite the fact that the Russell had a rough week, I think they're really going to be one of the beneficiaries. I mean, even on earnings basis, small cap earnings are going to grow 48% in the third quarter. That's like 5 times bigger than the S&P. So I think there's still a lot of growth left there.
Delving deeper into the private credit quandary, Lee distinguishes between opacity and outright credit deterioration. While acknowledging the former as a legitimate investor fright, he views current issues as primarily idiosyncratic, a stance supported by the stable behavior of high-yield spreads. The core concern in his view is a potential pause in capital flows, particularly into private credit as an alternative allocation, rather than a systemic credit collapse. This distinction is critical for understanding his broader market optimism. Lee reiterates his bold year-end S&P 500 target of 7,000, arguing it's a conservative base case given the historical average 5% Q4 return and the current Fed easing cycle mirroring 1998 and 2024. This bullishness is further fueled by strong early earnings season results, improved demand visibility, and diminishing tariff concerns, all contributing to an environment ripe for multiple expansion.
I know from a market perspective, you think both gold and the S&P 500 can each hit 10,000 by the end of the decade. I'm not a math whiz, but that's only about 4 years and 2.5 months from now.
Right.
Why so bullish?
Well, look, on the stock side, the economy has proven to be remarkably resilient. We've seen 3 years now where we've had the most widely anticipated recession of all times that just didn't happen. And notwithstanding all the shocks that the economy dealt with and continued to grow, I think the economy is going to remain resilient. I think we may continue to have these rolling recessions that affect different sectors at different times, but the overall economy, I think, may very well continue to grow through the end of the decade, which I, by the way, call the roaring 2020s, because so far so good. It has been roaring. I look for earnings to get down up to over $450 a share by the end of the decade, and apply a 22 multiple, and you get to something close to 10,000. Gold and stocks have a very interesting relationship. On a short-term basis, they're inversely related, but on a longer-term basis, their trends have been nearly identical. And I think gold is increasingly viewed as the safe diversifying asset that you want to have in a portfolio. It's definitely a risk-off asset, whereas Bitcoin is proving out to be more of a risk-on asset.
Yeah, Bitcoin's made a lot of people a lot of money, but it is down about 21,000 right now from its highs. So you've got to be willing to hodl, as they say, hold on for dear life and kind of ride that train, while gold just kind of quietly continues to make new highs almost every single day. It's been remarkable to watch. And by the way, silver too.
Correct. Well, I think there is a lot of wealth on the global basis, and I think a lot of that wealth wants to be diversified. Stock prices have soared around the world. We've had a global bull market. It hasn't been just the United States. People have a lot of wealth tied up in the markets now, and they want to diversify. And gold has kind of been sitting there for a while, but clearly gold is also a very good hedge against geopolitical risk. Maybe gold's down today on just some profit taking. Maybe it's because Trump is talking about getting together with Putin and Xi. But central banks, I think, are going to continue to buy gold. I think Chinese investors who lost a lot of money in the property market in China and have gotten whipsawed in the stock market there, I think they're buyers of gold, and I think Europeans are buying gold. You know, it's kind of like Bitcoin. There's no interest, there's no dividends, there's no earnings, so you can almost imagine whatever you want to imagine that it goes to. But the reality is, there's clearly a global demand for both kinds of assets.
You know, you heard President Trump mention the possibility of a meeting with President Xi of China, saying they want to meet, we want to meet, talking about hopefully there at some point an end to this war. Let's go to the former, Ed. And, you know, listen, neither of us is geopolitical strategists, but if we get that meeting and a photo op and the two, Trump and Xi, are smiling and there's a favorable de-escalation to trade, is that another leg up to the market, or has that in your mind already been priced in?
Well, I think ever since we had Liberation Day in, what was it, April 2nd, and that was followed by Annihilation Days, and Trump then postponed the tariffs, the markets come to conclude that Trump's going to get this thing resolved one way or another in a way that's good for the United States. And if it's good for the United States, it's probably going to be good for some of for many of our trading partners. But it's still an ongoing situation, ongoing talks. We have yet to hear the Supreme Court rule on whether these tariffs are even constitutional. So that could really start to stir things up, maybe whenever they get around to it. But all in all, I think the president's successes on the international stage are a positive for everybody, and they're certainly a positive for the stock market.
Despite recent turbulence, he argues these segments have been unfairly penalized, advocating for a throw the baby with the bathwater scenario in their valuation. With small cap earnings projected to surge by an astonishing 48% in Q3, a magnitude 4 to 5 times greater than the S&P 500, he sees substantial untapped growth potential. Looking further afield, Lee makes a compelling case for both gold and the S&P 500 hitting 10,000 by the end of the decade. He attributes the market's resilience to a consistently growing economy, defying widely anticipated recessions. For gold, he envisions its continued ascent as a global risk-off diversifier and a hedge against geopolitical instability, attracting significant demand from central banks and global wealth-seeking diversification. He contrasts gold's steady appreciation with Bitcoin's more volatile risk-on profile, emphasizing the enduring global demand for both distinct asset classes. This multifaceted analysis from Tom Lee offers a powerful framework for navigating the evolving investment landscape.